Okay, let's dive right into this explainer and look at how to actually build a portfolio that can weather any storm. We constantly hear this endless financial noise and see all these shifting trends, but today, we're cutting straight through all of that to look at the actual architecture of a truly resilient financial foundation. Here's a question to hook you right away. If you knew for absolute certain that the market always went up in a straight line, why wouldn't you just dump all your cash in at once? I mean, just a single shot, right? Well, you wouldn't, because you don't actually know that. The reality is the market moves in cycles. It never ever moves in a perfect straight line. And actually, that's exactly the point. Because there's volatility, investing steadily over time is actually way more powerful, not less. So today, we're going to untangle these complex financial threads step by step, leaning on the wisdom of a 20-year investing veteran. We'll cover 1. The modern investing shift. 2. Active and passive investing. 3. ETFs versus index funds. 4. Building your portfolio safely. And 5. Avoiding those classic first-time mistakes. All right, let's kick things off with Section 1, the modern investing shift. What's absolutely fascinating here is how the landscape has completely transformed. I mean, think about 25 years ago. Our veteran expert literally had to explain to people what a mutual fund even was. It was like this completely closed-off mystery club for the wealthy. But today, investing is a totally ordinary household conversation. The idea that mutual funds are a solid choice is pretty much baked into the public mind. And how did we get here? Two massive drivers. First, technology, literally putting investments just a few taps away on your smartphone. And second, strong, careful regulation that built a platform people could actually trust. It's a real game changer. Now let's move into Section 2 and the big debate everyone loves to argue about, active versus passive investing. When it comes to this debate, our expert completely refuses to pick a side. Why? Because the power of and is so much stronger than or. If you get trapped arguing over which single strategy is the absolute best, you honestly just lose out. Instead, a healthy combination of both is what builds a far stronger, more durable portfolio. And that perfectly introduces the core and satellite approach. This analogy brilliantly illustrates why you shouldn't box yourself in. Think of your core as the plain, everyday meal, the reliable, predictable rice and bread. That's your broad, low-cost passive index fund, or ETF, giving you that large-cap market exposure. Your satellite, though, that's the specialized dish. It's that smaller slice of active funds where a highly skilled human manager can try to outperform the market. They're often diving into mid and small cap stocks because, frankly, that's where there's genuinely more room to add some unique value. But here's the absolute crucial point. When markets get shaky, like when currency is under pressure, oil prices are spiking, and stocks are falling, leaning towards simple, transparent passive funds actually removes human hesitation and bias. Listen, even the absolute best fund manager is, well, human. A manager who bought certain companies with deep, passionate conviction might be really slow to pivot when the economic cycle turns. Plus, active managers often hold cash on the sidelines, meaning their personal judgment drastically shapes your outcome. A passive fund, it just moves with the market. No human second guessing, just pure low-cost transparency, which provides a really nice downside cushion when things get rough. Moving right along into Section 3, ETFs versus index funds. Let's look at the actual vehicles you use for passive investing. Okay, think of an index fund like calling a traditional taxi service, while an ETF is basically like an app-based ride. They both get you to the exact same destination, hopefully without too much traffic, just through slightly different methods. With an ETF, if you have a trading account and you understand bid-offer spreads, you can buy and sell right in the middle of the day at a specific price point. It's immediate, right? Just like hitting a button on an app. An index fund is the phone call version. You don't sit there stressing and watching the market all day. You just invest at the day's closing value. Same destination, same air-conditioned ride, just a different way of getting in the car. So if you want a systematic plan that just runs quietly in the background without you ever having to try and time the market, the index fund is absolutely your best bet. Why? Because you want something regular that you literally don't even have to think about. An index fund just debits your account and invests every single month. No remembering required, no logging in to check intraday prices. It just happens. Okay, Section 4. Building your portfolio safely. Let's dive into how to actually construct this thing without creating a tangled mess. For a first-time investor facing this massive, overwhelming menu of options, you really have to stop and ask yourself one critical question. how many funds do you actually need? Because a lot of people just assume that to be properly diversified, they need like a dozen different funds. But the surprising reality? Very often, the magic number is literally just one. Yeah, a single multi-asset fund can hold all the elements you need. It proves that if it aligns with your real-life goals, one fund can genuinely be enough. Inside this one single product, you get a bit of equity, some fixed income, maybe some commodity, and even global exposure. Honestly, if you want a tiny bit more variation, 2 or 3 funds from trusted names is plenty for most people. What you really want to avoid is what we call the wedding buffet trap. You know exactly what I mean. We've all been to a buffet where we just excitedly grab from the very first counter we see. Suddenly, our plate is overflowing with random things, and we leave completely confused, still hungry, and with a major stomachache. Well, in investing, someone mentions an ETF on a TV show, some guru says a sector is hot, and bam, your portfolio is a messy plate of random funds you don't even understand. Take your time. Walk the spread first, build a structured plate with a trusted advisor, and only then take a bite and invest. So let's keep it simple and look at how these buckets build on one another. At an absolute minimum, you want step 1, equity, and step 2, fixed income. If you want to take it a step further, add step 3, commodities. And one more step, add step 4, international exposure. If you get these 2 to 4 broad buckets right, you've pretty much solved most of the investing puzzle. But a quick warning, don't let the convenience of automation kill your asset allocation. You still need to step back periodically and just make sure those buckets are actually balanced. Finally, section 5, avoiding first-time mistakes. Let's cover the absolute classic pitfalls that trap almost every newcomer. Okay, so the biggest missteps, return chasing, buying blindly, and worst of all, panic selling right when your contributions could be buying units at a massive discount. People see strong past returns and just blindly assume they'll continue. Spoiler alert, they rarely do. They also buy without a goal. You have to set a real-life target, like funding a new clinic or saving for a new home, and then build the financial journey to reach it. And listen, during a market correction, the absolute worst thing you can do is panic, pull your money out, and stop your regular investing. That is the exact moment when your systematic contributions are buying way more units at much lower prices. And this traces straight back to the foundational logic of Warren Buffett and Benjamin Graham all the way back in the 1950s. Dollar cost averaging straight through the turbulence, that is how wealth is actually built. The logic from Graham's The Intelligent Investor holds just as true today as it did back then. It's the steady, unemotional investing through the entire cycle that allows real compounding to do its absolute magic. Now, for those of you in your early 20s, the veteran's advice is a bit tough, but it's so necessary. You have to push back against instant gratification and plow that income into long-term growth. It's incredibly unpopular advice today for sure, but investing more and investing heavily while you are young is literally the ultimate cheat code. You really have to resist the pull of fast spending. So use active and passive. Keep it simple, stick to your allocation buckets. But as you set up all these wonderful systems, I want to leave you with this one vital question to think about. Is your automation quietly building your wealth, or is it just putting your financial awareness completely to sleep? Don't let convenience breed complacency. Thanks for joining me for this explainer, and I'll catch you next time.